Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance bro. And today I'm talking to real estate investors and developers. Now, what if I told you there's a funding source for your real estate deals that you control completely? It costs less than hard money and builds wealth while you sleep. And the funny part is it's been hiding in plain sight this whole time. Now, right now, I'm talking to seasoned real estate investors who have mastered the game, but are still relying on banks, hard money lenders, and partners for your capital. You've got your attorney, your construction crew, and your systems, but you're missing the most powerful piece, becoming your own bank. So let's start with traditional funding and those problems. Let me ask you this. How much did you pay in your last deal? 8%? 12%? How long did the underwriting take? 30 days? 60? 90 days? How many hoops did you jump through? And then the kicker, where did all that interest that you paid go? Straight into somebody else's pocket. So traditional funding sources tend to look like this. Banks, 6 to 8%, endless paperwork, 45-day closings. Hard money, 10 to 15% interest, up 2 to 4 points on top of that, and then 6 to 12 month loan terms. You got private lenders at 8 to 12% interest, personal guarantees and limited capital, and then you got partners where you got to give up 50% equity for their money. Is this starting to sound a little bit familiar? Now let's look at the life insurance strategy, because here's what most investors don't know. Properly structured life insurance isn't just death benefit. It's a self-funding system that mirrors real estate investing strategies, and the similarities are striking. Let's start off with looking at real estate investing. Now, in real estate investing, you buy undervalued assets, you use leverage to maximize returns, you generate cash flow, build equity over time, you get tax advantages through depreciation, and you pass wealth to the next generation, generally through a step up in basis. Now, let's look at life insurance as an investment alternative. You buy an undervalued dollar, or your premium buys you more death benefit, aka your premium dollar buys you more dollars. You're using leverage because the insurance company's money is working for you. You generate cash flow because of dividends and growth. You build cash value or equity, like in a home, over time. You get tax advantages through growth and distributions. You get to pass wealth tax-free to the next generation. But here's the game changer. With the right policy, you become the lender on your own deals. So I want to try and give you like a side-by-side comparison of traditional funding versus life insurance funding. Let's start by the interest rates. So in banks and hard money, you're paying anywhere from, 8 to nearly 20%. Life insurance, you're going to pay yourself back at, anywhere from 4 to 7% and keep 100% of the interest. Let's look at the approval process. So in the traditional format, you got credit checks, income verification, property appraisals, which can take 30, 60, or sometimes more days. In life insurance, there's no approval needed. It's your money. You can nearly have same day access. Let's look at the loan terms. Traditionally, you got fixed terms, balloon payments, and personal guarantees, while in life insurance, you set those terms. You got flexible repayment options, and there's no personal guarantee to yourself. Now let's look at limits or capital limits, right? So traditionally, it's based on their criteria and based on what they have available in funding for you. With life insurance, you're only limited by your policy size, which you control when you initiate the policy and start funding it. Now, where does that interest go? Traditionally, it goes into your lender's pocket forever. With the life insurance strategy, it goes back into your policy, compounding your wealth. So now let's look at a realistic example. Let's say you got a $100,000 deal funded traditionally at 12%. So you pay $12,000 in interest annually. That means the lender profits 12K. Over 5 years, you've paid 60K, sometimes more in interest. Now let's look at that same deal funded through a life insurance loan. Let's say you pay yourself back 5% interest. So $5,000 goes into your policy. Your cash value grows. You've saved $7,000 annually while simultaneously building more wealth. Now, let's look at some strategic advantages. Because again, you're a seasoned real estate investor. So, as a seasoned real estate investor, you've already got the infrastructure. You already got the real estate attorney. You've got the construction crew. You understand deals flows. You have market knowledge, and you understand or you have exit strategies. But you're missing the capital control piece. With life insurance funding, you become the investor because you're buying properties. You become the lender because you're funding the deals. You become the wealth builder because your policy grows tax free. So, in essence, you have multiple profit centers from a singular strategy. So now let's take a look at this. You got property appreciation and cash flow. That's your normal real estate returns. You got interest payments to yourself, replacing what you pay to lenders. You got life insurance growth, which is tax-free compound growth. And you've got death benefit protection. So it protects your real estate empire in the event the worst happens. Now let's look at the compounding effect, because here's where it gets crazy and powerful. Every dollar of interest that you pay yourself goes back into the policy. That money often earns dividends, grows tax free, and becomes available for your next deal. Let's look at the traditional model. You get the deal, you pay the lender, you start over with the same capital. In the life insurance model, you get the deal, you pay yourself, there's more capital available, there's a bigger next deal, you pay yourself more, even more capital available. So you're not just building real estate wealth, you're building a funding machine. Now, if you're serious about taking your real estate game to the next level, stop making other people rich with interest payments, right? And the reality is, if you're a seasoned realtor, or excuse me, a seasoned real estate investor, you've already got an insurance guy. I guarantee you do. But your insurance guy isn't giving you this strategy, which is why you're a real estate investor, because the other real estate investor isn't using the strategies you use, which is why you have the portfolio you have. So again, stop making other people rich with your interest payments. Stop waiting for approvals on deals that you know are winners. Stop limiting your growth because of capital constraints. The investors who understand this strategy don't just build real estate portfolios. They build generational wealth systems. Your next deal could be funded by you, with interest flowing back to you, while building tax-free wealth that protects everything that you've built. If you're ready to learn how this works for your specific situation, comment funding below. I'll schedule an appointment with you to show you exactly how to structure this strategy for your real estate business. Because the best time to become your own bank was 20 years ago. The second best time is right now. Salute.